They've advised the Waltons, Kochs, Pritzkers, Redstones, and dozens of the country's wealthiest families. They brokered the record-shattering sale of the Boston Celtics, engineered the Paramount Skydance merger, and helped turn Kim Kardashian's Skims into a $5 billion business. With family fortunes skyrocketing, their firm sits at the center of a revolution in finance and generational wealth. It's called BDT MSD, born from the merger of Byron Trott's legendary merchant bank and Michael Dell's investment powerhouse. Today, it's two architects and co-CEOs, Byron Trott and Greg Lemkow, join Inside Wealth for a rare and exclusive interview. So Byron, you guys, as I mentioned, are so trusted by the wealthiest families in America. What do you think you have done or seen differently to be so trusted by those families and those companies?
I think the big advantage we have is we've been doing it for so long for so many of these families and business owners, so it allows us to really learn through them, their challenges, their objectives, and solve those things that they want to solve. And when you add that up over 3 or 4 decades, it allows us to be more impactful advisors to the next family that comes to us to get our advice or take our capital. And
beyond advice, and you mentioned capital, what are the sort of 3 or 4 basic things that you guys do?
We provide advice to business owners and their family offices, investment solutions. We provide capital, a different type of capital, and that was really how we really thought of founding the firm originally. Was we saw a gap opening in that the advice of Wall Street, a more transactional advice basis, was a bit distant for a business owner who wanted to keep their business for the next 40 or 50 years and through generations, or take minority capital, not controlling capital from the private equity firms. So I think it was a confluence of things that saw this opening that we could provide possibly a more tailor-made and better service in both advising family companies as if we owned it ourselves, and a different type of aligned capital that was longer in duration, 8 to 15 years rather than 3 to 5 years, and with the idea of working together and aligning interests, actually having them make disproportionately more money than we do if they hit their plan.
And Greg, when I think about BDT MSD, the defining word to me is duration. I know that's a technical term, but it seems to me what you guys do so well, particularly now that you're together, is thinking about not just the next quarter, the next year, but like 50, 100 years generationally.
Yeah, I think the magic of what Byron really created in BDT and what we've now since built on together is finding alignment, is finding what family business owners want in their business and what they want in their investing. And they want trusted advice, and they want long-term aligned capital. And as Byron built out this business, it was the same time that I think Wall Street became a lot more transaction-oriented and private equity became a lot more short-term. And so kind of the magic of what Byron's created is taking capital from family business owners who want to invest for the duration. They want to invest for a long period of time and invest in that capital into family business owners that want long-term capital partners. Sort of a magic model of combining long-term capital with long-term equity, all in the family business world, and then wrapping that with advice.
This is an economy that has a lot of cross currents. On the one hand, we have tariffs. On the other hand, we have the Fed easing. We have the stock market, which is doing fantastic. We have a job market that appears to be weakening a bit. When you talk to wealthy families, founders, what's the mood right now?
I'd say, with the families we talk to now are cognizant of the environment, and there's a lot of geopolitical anxiety in the environment, and valuations seem to be high. It doesn't necessarily impact their investing. And again, these families are investing for decades, and whether that's in their business or outside of their business. So they're less focused on exactly what's going on in the market right now and try to deploy capital to diversify their wealth and create economic opportunity over a longer period of time. So there's anxiety generally, but much less so than public market investors, which I've seen kind of blow in the wind.
But they are in the public markets too, right?
Somewhat, but they're still concentrated in their own businesses.
How do the people that you work with view the stock market?
So you have to understand our people. Our people are,
they own private companies, or they
75% of them still own their private companies or public companies, or some of both. The other 25% have taken capital that have sold businesses and now are redeploying it.
Yeah.
The one common theme with all of them, and this goes back 40 years. So from Black Monday in 1987 to 1999 technology bubble burst, to 2001, to 2008 and 9 great financial crisis, to COVID. All of those were short, reasonably short, V-shaped recoveries, declines and recoveries. Every single time, closely held company owners and their family offices leaned in. They leaned in, they invested more, they made acquisitions, they every single time. It is very consistent. That's Greg's point. They invest for decades. They manage their businesses in such a way that they have balance sheets that can do it. Those that have the private companies, which is the vast majority of our network, 80 or 90% of them, they preserve the balance sheets of their company and they start taking the excess capital and putting it in their family office with the objective of also compounding at 10% a year.
Right.
Usually below their company.
What about the inverse of that? When things are at a feverish pitch, like they are right now, as opposed to a bottom, are they taking money off the table? Are they saying this is too concentrated right now in terms of the number of stocks, in terms of the PE valuations?
Yeah, I'm going to say the beauty of the duration of family capital is they've got the flexibility to be risk on when they want to be risk on and risk off when they want to be risk off. And what we see
are they a little risk off now?
They tend to be a little bit more risk off now on their outside investments, but not necessarily on their core business. And that difference around investors who need to deploy capital and raise money and get it back and sell things, families just don't think that way.
And part of the reason they go risk off in their family office a bit, but stay with foot on the accelerator in the company, is to feed back money into their companies.
I see.
And then, but also just shifting strategy, going from overexposure to private equity to more in credit. Shorter duration, but also double-digit compounding.
What are the business owners seeing in the economy now, to the extent that you talk to them about demand, the consumer, even business demand? What are they seeing in the economy?
They're seeing resilience in the U.S. economy, surprisingly so. They're all a bit still recovering from COVID and the ramifications of COVID, and at the same time, a massive increase in interest rates in a very short period of time, right? So that's all being digested. That's why the private equity market and the liquidity of it is clogged up. The public markets have been shut down. But when they see that, and they see the market stretched, I mean, we all know that if you weren't invested in technology in the last 5 to 7 years, you were going to miss 70% or 75% of the performance of the markets in the public markets. So that's a missed opportunity. But what we're seeing them quickly adopt to is the AI generation. Everybody is focused on it.
How? How are they investing in it?
Well, they're all seeing...
Applying it to their businesses.
Yeah, exactly. They're seeing an unbelievable wave of technological development.
So it's not, I want a piece of open AI. It's how can AI reinvent my sanitation business or my food distribution business, or
how do I drive greater productivity in my business, regardless of whether it's driving top line, whether it's cutting down costs. And they're all seeing that and recognizing there's a massive technological shift that they all need to apply to their businesses. And they're all sorting through it. Not everyone quite knows how to do it, but they're all working on it.
And that's the mindset of the principal and his management team of the company. Over here, the family office is saying, we can't miss this. So we've got to figure out how and with whom we invest in technology.
How are they doing that? How are you telling your clients to do it, or how are you seeing your clients do it?
Yeah, we've historically been kind of risk off in technology, and as we've seen this last wave, and we've come together in particular with the overlay of Michael Dell, who kind of bridges generational family businesses, who's been at Dell as chairman and CEO for 41 years, with the next generation of technology founders. We've gone off and launched a technology fund, really backed by our families and founders, looking, just like we try to invest in generational businesses, we're now trying to invest in generational founders and businesses that we want to be invested in for the long term. And so we're trying to get exposure to our core families into some of these next generation technology companies.
And bring that, this is really one of the premises of coming together. MSD and BDT, neither one of us had really invested in technology.
Right. Because Dell wanted to diversify away from technology. He didn't want to go to AI. That's his company.
He's already got exposure.
Yeah.
Exactly. So it's really then building out a great team, which we've done over the last couple of years, and now doing a technology fund. But importantly, taking the knowledge we're getting from having 75 technology founders come to an innovators conference, and to take that knowledge and the interactions that our team is having with them on the advice side or on the capital side, and understand the trends and what's working and what's not. We have to bring that information to the broader universe of our business owners and our family offices.
Yeah, I mean, the real magic, having seen these two worlds come together, these multi-generational business owning families, and then these next generational technology founders. And they're so curious as to how these businesses have been able to last and be durable and create families and things around that. And the families are so focused on what's going on in technology and understanding how it's going to apply to their business. And so blending those two worlds together has been a really interesting opportunity for us as a firm and for our respective clients.
It's like old money, new money, right? It strikes me that the whole world of family capital has exploded. And I think the merger of your two firms was kind of this watershed moment where it really highlighted how important family-owned companies and family offices had become, not just in terms of doing deals with each other, but also in the broader deal world. So when you look at family capital, where it's headed, not just in terms of growth, but the amount of activity, what does that future look like?
Yeah, I'd say maybe I'll start with the family capital piece, and we can touch on next gen because there's two questions in there. On family capital, it really is differentiated. I think what we always like to think about, we always call ourselves long-term investors in a short-term world. And that really is the case with family capital. And it's becoming more and more differentiated. You know, the public markets are focused on a quarter or maybe a couple of quarters. Family capital is focused on decades and generations. And that's how they invest in their businesses. And the family offices that do best take that same mindset of investing in their businesses for decades or generations and doing that with their investments outside of their businesses. And the place I'd say that's the biggest differentiating advantage for family capital in this market is patience. And patience comes in a couple of forms. It comes in the form of not having to invest capital because you've raised a fund and need to put it to work, not having to sell an asset because your investors want money back. Our clients can be risk on when they want to be risk on. They can be risk off when they want to be risk off without any exogenous factors. And then the other element of patience is the ability to invest for the long term. You know, our families are focused on multiple of money, on compounding capital over a long period of time. That's the difference. It's not creating a short-term IRR. It's finding great businesses they want to invest in for a long period of time. And capital that is looking to be long-term can really be differentiated as a source of capital for companies that are looking for it.
And it's been a great evolution. Back when you look, when we really started this, 25 years ago, only 25% of the business owning clients or universe had family offices. They didn't have outside board of directors. They didn't, and it was a very, very different world.
What's driving that?
I think actually sophistication. I think them seeing the opportunities. I think we're a perfect example of when you see us come together, what 1 + 1 really did equal 4 when you grade it from what we're providing our business owning clients and the family offices, because now they have across one trusted platform 4 strategies, all very different, but the core theme is long-term compounding. The long-term compounding, Greg's hit it exactly right. They have concentrated risk in their companies. In the old days, 25 years ago, they would keep everything in cash. They would, back when I was doing private wealth management 35 or 40 years ago, they would just say, Byron, don't lose the money. Just keep it in cash.
It's all coupon clipping, right?
Coupon clipping, but that was their piggy bank.
Yeah.
I think as the world has evolved, their businesses have grown over time, the amount of excess free cash flow that's coming off of these businesses. I think there are still many businesses that are in those early stage. Yeah. We talked briefly, Greg and I were joking about Enterprise Rent-A-Car in 1989, the first time I meet him, when I was still in private wealth management the year before I went into investment banking. Jack Taylor, the founder, and Andy Taylor, the son who was running the company, they said, Sport, 1989, they said, I don't know who told you we have money. We are 10 to 1 levered. We have 10 to 1 leverage on our business. Now
private company rich but cash poor, right?
Yeah, and you wake up 36 years later and they're one of the model companies of the world. Significant excess cash.
You talked about next gen, and Byron touched on it there. Next gen is a topic that we're in dialogue with all of our families, and whether it's the current gen or the next gen, but it's clearly a topic. I think what we've seen with this current generation has been less pressure to necessarily go into the family business, which feels like it has evolved. And what I think we've seen families do is make sure this next gen is finding their passion. And their passion could be the family business. It could be social impact or philanthropy. It could be investing. It could be their own. And we look across our network of families we have the privilege of working with. Byron touched on Enterprise Rent-A-Car. You've got Chrissy Taylor, who spent 20 years in the bowels of the organization, rising up the ranks to come up and become the CEO to replace her debt. So her passion was the family business and is now taking enterprise to enterprise mobility and putting her own stamp on it. You've then got somebody like Lucas Walton, who really poured his passion into impact. And with Builder's Vision, which is massive scale and impact on oceans and the planet and agriculture, really having differentiated impact on something that was passionate to him. And then, the third is someone like David Ellison, who grew up in the shadow of his father as a technology titan, but is building his own path as really reimagining the media landscape with first Skydance and now Paramount. And so, all of those are such different ways for a next gen to go after it. But each of them are pursuing what was passionate to them. And I think that lesson on any scale for multi-generational families for the next gen is finding out what's most important to them and then applying themselves against that.
And so many times, and I was talking to Warren Buffett about this recently, he said when he talks to other philanthropists, the number one issue they want his advice on is kids. And I know one of the values that you provide your clients is these frequent get-together events where they can get together. And I know that at your events, they might ask a question to the room of, let's say, should you allow your kids to fly private or should you make them go commercial? What are some of the more interesting, specific questions that you've heard asked or answered at some of your What About the Kids sessions or discussions?
It's a really important...
What about flying private? What do people say about that? Do they say yes, no?
I think many of us would say that, it's not the house they live in or the jets or the planes or the cars they drive. It's the people in the house and in those cars that are teaching them how to have high integrity, a North Star, have impact. The great thing about this generation, the rising generation, they care dearly about impact. Mm-hmm. They want to impact the world, and what's nice about it is...
You think more so than other generations?
We do.
Yep.
We're seeing it in a major way.
And that's consistent.
Very consistent. Very consistent across families. And I think it's that psychology part of it that you ask about. In the old days, it was you were raised to go work for the family business. Well, any family business is lucky to have one person in a generation that actually has the passion and the capability to run that business. Enterprise Rent-A-Car, we mentioned it. They actually took an 8-year, hired a non-family CEO from inside the organization and helped train the next generation, which was a generation removed. And those types of plans and learnings, very important for the maturation. The Waltons, Walmart, Rob Walton didn't want to be CEO after Sam.
Right.
And they built a whole different infrastructure, and they are to preserve
incredibly
their culture.
Successful.
They did not sell their business. They kept going. Incredible story. And now they can train to be chairman. They can't train to be CEO. And those different succession models, there is no, like Greg said, there is no one model. Everything is different.
What about the question must come up a lot, how much to leave your kids? What are some answers that you hear that are good answers on that?
So again, across the board, some have kind of just enough to stay off the skid row, and some meaningfully more significant to be able to go start their own businesses. And there's a wide range. And what's interesting about the gatherings we get with the families is the parents trying to figure out how to raise good kids and what their values are and how to instill their values in their kids. The kids are similarly trying to figure out how they need to behave and having a peer group for them of looking at others that are in the same spot that you can't go talk to your friends in college about because you might sound like a stuck-up jerk. And
but you do a lot of that, connecting those peers, the next generation, and they don't get those opportunities outside in the world that often do.
That's exactly right. And having the ability to really share those best practices and worst mistakes and what you end up doing. And I'd say to your question, Robert, on flying private, I'd say that the most consistent answer is the families who feel like they've earned the money to have the privilege like to enjoy some of the benefits of the privilege. And so the kids can fly private if they're with their parents, and if they're on their own, they fly commercial.
The one important thing, though, is on how much to leave the next generation. How do you do it? It's when you look at the basics, and we've learned this from some of our best clients 20, 25 years ago, providing capital while they're young. Now, it's a really important discussion, and there's no right answer. When do your kids become aware of how much wealth the family has? Now, in today's world of
Google
nothing's private,
yeah,
I mean,
exactly.
There's no way to hide it. But a dividend policy, we learned this long ago in our very first round table by one of our great iconic families, multi-generational, continues to thrive, and is that you have to make dividend policy enough to the beneficiaries of the next generation, so they're forced to spend modestly, but invest on their own. And then they come to respect the business that has been built before them and realizes how hard investing is.
So be specific on that. When you say dividend policy, you're giving them that training at an early age.
Right.
we call it an allowance. It's probably a couple more zeros when it comes to your families. But how does that work? You start at the age of 10, give them some money to invest in stocks, or what? Or
do that? I'd say a little bit later. I'd say typically. I
20?
mean, again, there are models that work everywhere.
Right.
Warren Buffett.
Things that you've seen successful look like what?
Usually post-college, where you actually start giving them a dividend, either a distribution that matches the income they're making at the job they're in, or just enough that they really are forced to invest. What we say, force your kids, force your grandkids to actually drive the car rather than sit in the driver's seat.
And then all of a sudden wind up in the driver's seat.
Yeah, and by the way, some of them are really good at it. And they're way better. They'll invest in tech stocks. You got early on tech, tech stocks. They're way better and way faster.
The education on the investment side is critical. Like what we tend to do when we gather this next generation is actually sit down with them and take them through the investments we have on behalf of their family, so they understand exactly what it is they're invested in and why this asset class versus this asset class, and how we think about risk-adjusted returns, and not just getting the dividend from the dividend policy, but really understanding what's behind the investments.
What do you see, and what are some advice pieces that you would give family offices, 3/4 of which now are doing some kind of direct investing?
I would say direct investing is not easy. The core kind of principles that we tend to live by is you have to have great people, both with high integrity but experience that matters and is specifically.
Great people doing the deal due diligence, or great people managing the company you're investing in?
Well, both. So you have to have a team inside your family office if you're going to do direct investing. So we have the basis first. Fund investing is very important for a family investment, for a family office. It sounds very self-serving, but private equity funds, professional investors, full-time teams, full-time expertise over decades, very important to align yourself with and learn from, but you have to be important to them. So a lot of family offices make the mistake of taking $1 billion and spreading it across 50 funds.
Right.
Not a good idea. Administratively burdensome, you immediately become average. It's very tough to unwind. The tail lasts for a very, very long time. So, but aligning, and this is to your previous question about why his family office capital exploded. For the first time, there are multiple strategies, from 1 to 3 years in private lending, private credit. There's 3 to 5 years in capital solutions and a different type of credit with a little bit of equity risk. Then there's the longer duration private equity. You have a lot of choices now. So pick some spots, learn from them, leverage off of them, get their co-investments, and then learn from that, but have your own team, including, we often say, just have somebody help you with the direct investing and the diligence. If you haven't built out a team, only the largest, the super large, sophisticated family offices really can afford to build the type of team to spend full time doing direct investing, and then to partner with somebody you trust, but also somebody has to take control and really be responsible for the outcome.
Yeah, direct investing is a skill, and it's hard, as Byron mentioned, and it's one that can be developed over time with experience. So it's a hard thing for a family office to go directly into. And so the advice we have is, as Byron noted, hire the right team, find the right partner, learn alongside a partner, and evaluate a couple of investments and underwrite them together.
Do you think that with all of the attention now on the ultra wealthy, that it skews too much toward the tech wealth, the celebrity wealth, the sports wealth, and the quiet wealth, the industrial wealth, the families that we have never heard of, or most people, the Duncans, the Taylors, these are families worth $20, $30 billion, the Koch family, the S.C. Johnson family. Do you think most wealth in America are people that we haven't heard of in industries that we don't think of as the future?
Yeah, Greg and I have been doing this for 30 to 40 years, and we walk into each other's office every week and say, how did we not know about this company? How did we not know? How do we not know Bob and Susie?
Even you're discovering wealth that you didn't know about.
Every week.
It's amazing.
Wow.
I mean, there is so much hidden, quiet wealth in this country.
And it's not in some glamorous industry, is it?
I mean,
rarely is it.
Rarely is it. And the most impactful, best. I mean, nobody knew an enterprise rent-a-car 15 years ago. But quiet, methodical, doing the right thing, It's everywhere, and that's what gives you inspiration about America and everything else. Whether it's, and a lot of these companies are in out of the way places, but the ones that get the media attention are the more of the sizzle and the tech. Tech is really important, and we're finding the trends that we saw 30 years ago in consumer companies, industrial companies, Midwestern companies. The tech founders are just now emerging into. All of a sudden, they have big wealth, big liquidity, and now foundations, kids, and they need help. They need trusted advisors around them to help them deploy that capital.
You've been an important figure and leader of the Horatio Alger Association, the idea that rags to riches is possible in America. Do you still believe in that? Do you think that dream is still going to be possible 10, 20, 30 years from now?
Completely, 1,000%. There is so much opportunity in this country. I get so inspired every day. Horatio Alger kids, when you look at them and the grit and the fortitude that they have, but now over the last decade, we built our own form of, because I came from a small town, my wife came from a small town, there are plenty of kids as smart as me in that small town, but they didn't get the advantage, or they weren't made aware or prepared to go to four-year college.
I want to finish on sports because you guys have done, you did the Celtics deal, you've done, I think you're involved in the recent Julia Koch thing with the Giants, maybe not, but you're involved certainly talking to a lot of the families that own NFL, NBA franchises, and also in the European soccer world. How serious is it? And do you think that there's a potential for a bubble in that everyone looks at NFL valuations and then they think, well, if I buy this WNBA team in wherever, that's going to have NFL-like growth?
Yeah, I'd say so. Sports, with the increase in valuations over the past decade or two, it's really become an asset class. It's become an investable asset class for family capital. And if you look at the 5 major sports leagues in North America, there's 150 or so teams. The aggregate value of those teams is probably $600 billion, $700 billion. So it's a really big, deep market. At the same time, you've had the introduction of institutional capital.
Right.
So you've now got liquidity. You used to not have liquidity in these things. So you've got a really big, deep market, and you've got liquidity, so it can be investable in a way that it hasn't. And if you look over the past 20 years, owning a franchise in any of those leagues would have given you a better return than the S&P 500, and with less volatility. Now, will that always be the case? Who knows? But it's really demonstrable increase in value. You've got liquidity and you've got scale, so it's become investable. When you layer on top of that some tax benefits for certain families, it becomes really attractive. And then the qualitative thing we've seen around sports ownership is really twofold. So many of our families are really focused on their community, and owning a sports team and investing in that sports team in your community can be a great way to bind that community. And the other one, in particular with multi-generational families, you get down to generation 2 or 3 or 4, and no one's left in the business. And buying a sports team is a great way to get that family back to rally together around something they can all be in on together. So I think this trend we've seen around sports ownership in families is only beginning.
And the values will continue to increase. We represent owners across all of the major leagues, and 10 to 15% of our network own professional sport teams alongside their companies. We have at least another 10 or 15% that will invest in a team in the next 3 to 5 years.
So Byron, a lot of people first heard your name in Warren Buffett's 2003 annual letter, where he said, Byron Trott understands Berkshire far better than any investment banker with whom we've talked to, and it hurts me to say this, he said, but he earns his fee. What is it that you think you did that impressed Buffett so much, and what does it say about what BDT MSD does today?
It's a great question, and it's one that many don't understand fully. We have this great benefit and this great seat of advising so many great people like Warren, and business owners. We learn from them. We try to have impact on what they do and how they do it, but we do that by taking in and listening to what their challenges are and their long-term objectives. And there's so many great families that we've learned from, but I'd say Warren is in a league of his own. He's encyclopedic about business and metrics and knowledge and how to identify durable cash flows, durable companies. He has discipline like no other. He says, use the philosophy of Ted Williams as a batter. Wait for your pitch. He had great batting average because he only swung at those pitches he knew he could hit. And Warren, I've learned this just a massive amount over the years. He's a great teacher. There will be no one like him ever to replace him. I don't care what people say. He's a great human being as well. So I've been a great beneficiary. Our firm has been a great beneficiary of he and many others. You know, you look at the Koch family, you look at the Pritzkers, you look at the Taylor family of Enterprise Rent-A-Car and the Waltons, and we've just been privileged to be able to advise and sit beside them over the years and help along the way.
Well, you two make a great team yourselves. Thank you so much for joining us today. We really appreciate it.
Thanks so much for having us.